Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there, just to let me know that it is indeed working. Hope everybody's having a fantastic morning so far. Hopefully your weekend was awesome. Looking forward to trading with you guys today and to go over our basic training webinar. Today I want to talk about the use of indicators, specifically one of the more popular platforms out there that creates indicators, which is Lux Algo. Really hit the scene here in the last year, maybe 18 months. And so I want to kind of share my thoughts on them, some of the indicators that I use from them, some of the indicators I don't use, and just my thoughts on indicators. So I'm really excited to share that with you guys today. Okay, so before we get started, as always, I need to remind everybody about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys. Well, let's jump into this. So let me show you guys. So let's go straight to Trading View. So this is where I take a lot of my trades. As you guys know, this is where I do a lot of my analysis here. As you guys see me doing the live trading rooms, and you guys watch me trade price action. I look for my setup is very interesting. Like I look for a break of structure. I look for a market that's moving one specific direction or another, and I'm looking for a break in that structure, um, usually on an hourly time frame. And it really doesn't matter what pair it is, if it's a CFD like NAS 100, US 30, oil, or if it's Forex pairs, it really doesn't matter. I'll trade anything that has the setup. So basically what I'm looking for when I'm trading is, in fact, let's just pull up. In fact, this is a trade we took earlier today. Let's pull it up. Here's the NZD CAD. Here's a pending order that we're waiting to have execute. Basically, this trade setup, we identified this morning a break in structure right here and a break in structure up here. You can see I've got, here's your break right here. You had a nice little structure zone up here, resistance, nice little resistance up here, correct? And then we wait for a break in structure. And then the thing, after you get that break in structure, it's like, okay, great. Now I want to buy, but now what do you have to do? The next thing you have to do is you have to figure out where are you going to take that buy position? Where are you actually going to get into this trade and try to make some money with it, right? Is the big question. So most of the time I can figure this out just by looking at a naked chart. So this is with no indicators. As you can see, I don't have any indicators at all on my chart. It's just a white background with candlesticks and then a few pointers or a few elements here that I've put on the chart here, but that's it. No other indicators. Now, so let me back up for a second and then we'll come back and preview this trade setup in just a moment. But a lot of people ask me, why don't you use indicators? I think maybe 10 years ago, 15 years ago, it was pretty like when I first started trading 11 years ago, it was really common to use indicators. Indicators were the way to trade. It was how you identified an opportunity when you got like a MACD crossover, RSI crossover, some moving average, whatever. That's how you found trade opportunities. And some people still trade that way today. However, indicators are becoming kind of a thing of the past, at least those types of oscillating indicators, moving averages. When people use moving averages today, they use it in support of their price action. They don't really use it as the primary reason as to why they take the trade. So that's why if you see a professional using a moving average, it's going to be just to verify where the where the median is in the price. So you'll often see people use like a 200 EMA or SMA moving average just to kind of see where the market has historically been relative to where it is now, right? That's what somebody might do. But in the past, what you would do is, in fact, let me actually just do this with you guys. I might have to remove some things here. Yeah, let's remove this. And let me remove, I'll just remove this for now. If I were to go out here into TradingView and click indicators, the first thing that pops up is the most common indicators that have been around for forever, like the Bollinger Bands. John Bollinger created the Bollinger Bands in the 50s, 60s, I can't remember, 50s or 60s, he created the Bollinger Bands. They've been around forever. And even before computer screens, Bollinger Bands were a thing. And now we've been able to, especially over the last couple of decades, we've been able to see Bollinger Bands manifest on an actual chart. So what I want to show you though is like a traditional setup that this is how people still trade this way. And I don't know if it's a terrible way to trade because I haven't done it in a long time. I think there's way better ways to trade. But you can just pull up a simple moving average, which is like just a smooth SMA. Let's pull that one up. And let's actually add another one. Okay. And then if we hit the settings on here, you'll see this is a length 7. Let's change this to 200. And let's change this other one. If you go into the settings over here, you change it to 50. This is a really common thing. So what people, and some people still get up in the mornings and this is how they trade. They'll just put up on SMA. Here, let's go back in time so you can just see the price action with this. What they do is you have a 200 SMA and you have a 50 SMA. Okay, that's really common. So here's your 200 is the blue one, and then you have a 50. This is just your traditional crossover strategy. Okay, and what you're trying to do is if the purple one, which is the 50, crosses above the 200 one, you're looking to buy. So you're buying if it's crossing above here, and that's one way to do it. When it pulls back here, you can see the purple crosses below the 200. Now you're looking for sells. Looks like it crosses up again. Now you're looking for buys. Oh, crosses down. Now you're looking for sells, right? So that's kind of how, like I said, in general, people would trade using the 50 and 200 SMA. I'm not a big fan of this because one of the problems you have with this type of style of trading, in fact, let me pull up a vertical line here so I can show you what I'm talking about. So let's put this on here. Let's go back. If you put a vertical line where it crosses, you can see it crosses right there. So by the time you're getting this signal, the market's already moved up to this point right here. Then you're looking to buy. Maybe there's still more to buy at this point, but you'd miss out on quite a bit. Over here, you can see it crosses over twice. So you have a crossover right there to the downside, and then it crosses over to the upside right there. And actually, that would have been a terrible time to buy. You can see right here, it crosses up. The purple line crosses up, and that's when the market peaked, which is too bad because a lot of people use that as a buy signal, and it would have been just in time for this thing to head to the downside, right? And by the time you're alerted that it's going the other way, this is where it crosses the other way. See this? Watch this. If you click right here, put a vertical line in, this is when it finally crosses the other direction, is when it's here. So you had a buy signal here and a sell signal here. Now, the sell signal obviously would have been great because it continued lower, but the buy signal would have been about the worst timing possible. So that's one of the issues with these crossover systems. That's very common. This is one of the first ways people learn to trade is to trade a crossover system like this because it's just so simple. You just buy when 50 crosses above 200 or you sell when 50 crosses below 200. It's just that easy. But nothing comes that easy, as you guys know, right? So one of the issues you have with that is unless you're managing your risk correctly, you're going to get burnt with a strategy like this. Or unless you have another way to filter out trades, you're going to get burnt. So a lot of people will eventually abandon the market and quit just by doing that. And they really don't learn any price action, right? So this is not a price action strategy. It's just a follow the rules, which is buy when it crosses above 200, sell when it crosses below 200, right? just a nice way to do it. But again, it's going to require a lot of discipline and grit to make it work. I'm not saying you can't make this style of trading work. It's just going to mean that you're going to have to stop out quicker when things don't go your way. You're going to have to be at your computer waiting for those setups to actually come out. Um, what you could do is, this is an hourly chart, so it's going to be hard to see setups on an hourly chart. So it's very common for somebody to do this on like a 1 minute chart or something like that. Um, so but anyway, back to the topic. So the topic's on Lux Algo and other indicators, right? So this is probably the most common indicator. Um, um, like the SMA is probably the indicator out there that's most common. It's been around forever. And the 250 crossover is perhaps the most traded strategy, especially for a beginning trader. And again, like I said, I'm not saying it can't work. I haven't been able to make it work myself. I don't know. Maybe I just don't have the discipline for it. But if it's just really hard because if you're gonna trade this way, the signals I have found to be somewhat unreliable. For example, this crossover right here, somewhat unreliable. And so if you're going to trade a strategy that has an unreliable signal, you really have to manage your risk per trade. And that goes for any strategy, right? But especially I'd say um for this type of a style, you really have to manage your risk, which means you need to have, a 1 to 2, 1 to 3, 1 to 5 type of risk to reward ratio to even make it work, right? Which again, that takes some real diligence, some real discipline, because if you're up 1 to 2 and you're supposed to go to 1 to 5, you have to hang on to your trade and let it go to its target, which can be really hard to do sometimes. So, and the other problem that this brings up is you never actually learn price action. You never actually learn liquidity. You never learn liquidity sweeps and mitigation and imbalances and other important details about how the market actually works, right? So that's my issue with a lot of these, what a lot of people call retail indicators, is you don't ever really get that extra, um, you don't get exactly what you're looking for, if that makes sense. Anyway, so what do you do? What do you do with this? Um, so what I like to do, as far as indicators go, I don't use those indicators very often. And kind of like Roger says, they're nice to develop a glance of a trend, but it's not your primary reason for entering the trade itself. Oops, did I delete all the, yeah, I did. Geez, can I put all that back actually? Did I delete all of my stuff? I think so. There we go. I didn't want to delete there because this is all my stuff from earlier that we did in live trading. I didn't want to delete that. Okay, we're good now. Thank goodness for control. Was it control Z? Yeah, control Z is what I just clicked on. Okay, so let's go to object tree and let's just remove these guys. We don't need this, and we don't need that. We can remove this arrow. Good. So, and this is exactly. So this is where we're going with this. So Roger hit it. So liquidity and structure is how price works, right? So price action, when you're looking at a chart, you're trying to understand where the market is breaking to. Is it breaking up or is it breaking down? Is it forming higher highs or higher lows, lower lows or lower highs? Right? Those are your clues. Those are your most significant clues as to what is going to happen next in the market, right? So, for example, with this trade this morning, we have a belief that this market's going to continue to head higher. Why is that? Well, because when you look at this trade setup, there's a lot you can break down and dissect from this most recent move throughout this region right here. So, right through here, you've got higher lows, right? That you have an apex low that swept a bunch of liquidity down here. And then you have these higher lows that came out of it. So that's a sign. And the fact that you have higher lows and you have higher highs also forming in this area, It also formed a lot of volume because the market spent a lot of time in this area. As it was forming higher highs and higher lows, it was forming volume. So that's what's that likely going to lead to? Was likely going to lead to a leg higher, which is exactly what it did. And then not only did it, when it broke the leg higher, it was very robust because it broke structure here, it broke structure here, and and then left in its trail a series of demand levels, right? So this is where I want to go. So the original topic is on Lux Algo and indicators, right? So what indicators could be helpful with trading price and structure, like Roger says? Well, I think indicators that help you find order blocks can be very helpful. I've used them for years. The Lux Algo order block detector I've used for like 18 months consecutively, pretty much every single day. So it obviously works. I mean, it's not nothing's 100%, but it obviously is helpful and can help you take better trades. Now, also kind of like Roger said earlier, is this something that you just rely on completely and wholly? No, it's a way to filter trades and find opportunities and confirm the opportunities that you've already found through your own price action skills. Okay. So when I pull up, I have them loaded up here. When I pull up the order block detector, for example, just let's just do that one for now. The order block detector shows me down here these green blocks. These are where supposedly banks put in orders. So there's orders down here, orders here, orders here. That makes sense for these orders right here because obviously what happened after these orders came in? Boom, came up, right? They put in an order up here. Why would they put an order up here towards the top? Probably because they think it's going to keep going higher. You don't put orders there at the quote unquote top of the market unless you inherently believe the market's going to continue higher, right? So so we saw this. We said, okay, we got higher highs, higher lows, breaks of structure, robust move. And then when we pull up the indicator, we get a demand zone right here on the hourly. And then when you go out to the 2 hour and see if that can stays, sure enough, it's another demand zone, more demand down here. I think the 3 hour even has one. Yep, 3 hour does. Now there are a bunch of supply zones up here, and that is something to be aware of when you get out to these other time frames. Um, that's something we discussed this morning, that there could be some pullbacks, but I think those pullbacks will be met by those demand zones and subsequently will send the market even higher. Now, when I go over to the other indicators, let's turn this one off. I have another one called Sonar Lab. Sonar Lab is another different company that made their own order block. And when I turn that one on, you can see where the order blocks are. So you can see down here where this breaker structure took place, there's quite a few order blocks in this area. There's also some order blocks right here, which is exactly where we want to buy. Yes, there is some supply up here, and that is what's kind of keeping the market at bay for the moment. But I do believe that supply is going to the fact that the market came up here and is staying up here tells me that the demand is going to prevail, not this supply. And that gives us permission to go on to the next supply zone, which is up here. And this is where I want to target. And this is where you may want to consider start selling, but not until there. You don't want to sell right now. It's not a good place to sell. It's actually just more time to buy than sell. And up here, when the market finally gets up to here, we'll go ahead and start selling. But for now, continue to buy. Okay. So use that indicator. Now, how do you find these? Because they're very helpful, as you can see, right? Like you can definitely see, okay, if you're looking at this chart and you saw that break of structure and you found that that's demand, well, then that's a good place to probably buy. You can get really good risk to reward ratios if you put your entries around demand and stop out when you get outside of that demand, or same thing with your sells. If you're looking for a sell at supply at a supply block, and then put your stop loss on the other side of that, and then let that thing fly. Do markets go past that and hit your stop losses sometimes? Yes, absolutely. That's why you have to stop out. You have to take that loss, move on to the next one as quick as you can, right? But so far, this one's good. We like this one. Um, and it has everything to do with structure and liquidity and where structure and liquidity is. And so, like I said, I believe you'll get a nice move to the downside here that'll hit demand. And then my expectation is that it goes up from there. I don't know if it's going to play out exactly that way, but I have to play to what I see. And that's what I see right now. Um, okay, what else? What else here, guys, is really good? Oh, another note I'll make real quick. Notice the last time the market was in this area, it was right over here. Last time it pulled back very quickly. Came up to here, pulled back quickly. Came up to here, pulled back quickly. What's it doing now? Came up and it stays up. That's another clue. We need to pay attention to that. If the market comes up and stays up, it's more likely to bust through the rest of the supply and go to the next supply zone. It's more likely to hit demand and then just go up from there. If it were to come up to here and pull back quickly, I wouldn't be interested at all because that means supply is prevailing, not demand. But at the moment, there's not a lot of sellers, at least institutional sellers, that are willing to send this lower. It seems like they're coming up here and they're staying up here. They're making a home, they're making a nest to do it again. They're trying to send this and make another leg higher, which is what we're trying to play. We're trying to be a part of that. Now, how do you find these? Let me actually turn these off and let me remove them from my chart completely. I also like this one called Smart Money. This is a good one too from Lux Algo. I'm going to take that one off too. So how do you find these indicators? So if you're looking at your chart, you do have to exit out of the full screen. You have to come out here, and then you have to click on indicators, which is here at the top of trading view. Okay. And then you can search for whatever indicator you want. Just so you know, new indicators get uploaded onto TradingView about every hour of every day because TradingView is it's an open source platform where people anywhere can create indicators and give them away for free. They can sell them on TradingView. It's a beautiful thing. It's a crowdsourced platform. MT4 does this a little bit. It's more monetized. Here, I feel like TradingView has created a place where it's a little bit more hands-on and helpful to the trader because you have a lot of people who aren't necessarily looking to make money with it. They're just trying to build a following. And so they give away pretty good indicators for free. I have found some really good gems here. When I'm just looking for indicators, sometimes I just search for what I want. If I think of an idea in my mind, likely somebody's already created it. And so I just go in here and search for what I'm looking for. For example, one day I wanted to find an indicator that helped me track volume. And I searched volume and it came up with like hundreds of indicators on volume. And then you just kind of comb through the ones that you like and you don't like, uh, and then you just kind of pick one that kind of fits what you're doing best. Um, I'm not saying you should do that as a strategy. It's just a great way to research and find out what's available out in the marketplace and see what people are doing. So for me, I like these order block indicators. So when I go in here and I just search order blocks and watch this. If you just search order blocks or just order block, period, that's it. Look how many there are. So many, dozens, at least dozens that there are. And I've come through quite a few of these. I think if it says EP, that means you have to pay for it. No, you don't. Okay. But that's not the one I want. So I'm going to delete that. I'm going to go back here and search order blocks again, order block. If I search, right here is one I like. Well, several of these. I like this order block detector from Lux Algo. That's probably my favorite one. So I click on that and now I have it on my chart. And you can turn it on and off like this. I unhide it and hide it just like that. Pretty nice. Okay. Now I like other order block indicators. So I search order blocks again, order block. And then the one I also like is this one from Sonar Lab. I like this one. It's kind of nice to have a variety of different order blocks because if you have a variety of order blocks, then maybe one indicator catches a certain place because they calculate it differently. I'm not exactly sure how they all do it. Other than I do know one detail about SonarLab. SonarLab, when they calculate order blocks, it's based off of the candle, the actual single candlestick. So when you look at these order blocks here, you'll notice, let's zoom in. This order block right here is going off of that last red candle before this market broke to the upside. So they're going off of the banker's candle, which is often the last candle before a major leg. So that's how they're doing it there. You can go down here and see, yep, they're taking that candle and saying that that's an order block. Right here, they're saying that this is an order block, this guy before this leg higher. So I'm not exactly sure how Stoner Labs figuring it out, but it seems to be that they're just going off of the banker's candle versus if you use somebody like order block detector, sometimes they go off of an actual location. So you kind of get the best of both worlds. Like one's trying to find a volume location, the other one's trying to pinpoint an actual candle. Kind of depends on your preference and what you like. What I like to do is I like to put both of them on my chart, and if I can get both of them to overlap in a zone, then that tells me that that most likely definitely is an order block. So, for example, right here, where we have our entry on this trade, you can actually see that there is indeed two blocks right there. There's one that goes down to here and another one right in the middle. That's the detector from Lux Algo. Okay, so that probably is a good demand zone right in there. Probably if we trigger into this trade, that's probably where it will go before it goes up again. So we might actually see it come down a little bit, come into here, and then go up. Something like that is what we would see. Um, so I like them when they overlap. So I do this though. It's really important. This part is really important. I do that process after I've already gone through my setup. I've already gone through the price action setup. So basically, I'm trying to find, is this actually a break of structure in the first place? Is this actually bullish price action? Okay, we've established that it is. We're breaking structures. Now we pull up the indicator, and the indicator helps us confirm the zones that hopefully we were able to find already. But if we can't, it kind of tells you where those opportunities might be. So the indicator itself, these two indicators help me hone in my entry, but it's not the actual strategy. That's how I would think, in my opinion, you guys, it's up to you guys. I think that's the best use of indicators. If you're going to actually put indicators on your chart and use real estate on your monitor to allocate to an indicator, it needs to be an aid in confirmation or even invalidation. So if you need to invalidate a trade, sometimes indicators can do that. And that's a good thing, actually. If you can invalidate a bad trade, then that'll save you some money, right? So I like these. The other one I like is the Smart Money from Lux Algo. I don't use this one as much, but it is pretty awesome because this will teach you price action, by the way. If you just let's turn off everything else except this one. Let's go back in time. Let's just look at a chart with just smart money on it. So this is kind of cool. This will teach you price action concepts. So notice here it says boss right here, and then it says boss here or CHoCH. They're also known as CHoCHs. Um, CHoCH. It almost looks like something from chemistry class, right? Where you've got uh chemistry where it's just like, I don't know, is that some kind of molecule? CHOC? I don't know. It's kind of takes me back to, going back to school again, I guess. Anyway, and then you got these BOS. So what does this mean? What are all these things mean? Let me kind of give you a little price action lesson on this real quick. If you guys are okay with that, I think this will be very helpful. So a CH, actually better understood this first. Let's understand what a BOS is. So a BOS stands for break of structure. So whenever you see this on your chart, or if you draw one on your chart, a BOS just breaks structure, um, always in the direction of where the market's already going. So if the market was already going down like it was, and you get a BOS, that's just a break of structure to the downside in the same trend. Okay. Um, that's what you're looking for. Um, the dotted, I'm not sure why they do these dotted COHCH CHoCHs or these dotted BOSs. I think they're not as solid if they're dotted. I think that's probably what they're saying. But when you have a solid break in structure, then you know that a solid line, then you know that that actually is a break of structure. And then you got these solid lines that are CHOCH for CHoCH or chalk. I don't know the pronunciation on them. I don't know the best pronunciation, but anyway, let's talk about it. So break of structure is very simple. It's just you have a support level, market breaks below it. Okay, you have a resistance level, market breaks above it. That's a BOS. Very simple. So what is a CHOCH? CHoCH. Basically a CHoCH or a somebody in YouTube tell me whoever's watching this on YouTube or live on the calendar. Can somebody let me know if is it CHoCH or chalk? I don't know. I don't know. I've always said CHoCH. Anyway, okay, so what is it? So it actually is a break of structure, but it's a different type of break of structure. That's what a CHoCH is, okay? Um, and it stands for change of character. Yes. Yeah, I'm just trying to remember how to yeah, thanks for telling me that, Roger. Yeah, it stands for change of character. Thank you. Yep. But I'm trying to understand like what's how do you say it in the most abbreviated way? So why is this a change of character? So it actually is a break of structure, but it's a specific type of break of structure. It is a break of structure that is the first of its kind in a new trend. So for example, you have a downtrending market right here. You have a bunch of BOS, downtrending market, downtrending market, downtrending market. And then all of a sudden you get a break of structure right here that was preceded by all this downtrend. So you have a big downtrending market and then you get a CHoCH. So what does that mean? Well, it means that um, you have it's just you have a first break in a different trend. The trend is now changed. At this point, it's no longer an uptrend, or excuse me, it's no longer a downtrend. It is now an uptrend as soon as this takes place. So right here would be your BOS slash change of character. And I call it Chachi like Chachi from Who's the Boss? Nice. I like that. Usually, now this is not always the case, but typically these matter more. They're more powerful than just a BOS. Okay. A change of character is often, not always, but often more powerful and more significant than a BOS. Okay. Because if you can get one of these, usually this means that the banks have finished their selling or their buying in that other direction they were going and have now determined to go the other way. So if the market ever pulls back after a CHoCH to the upside like this, it's often met with buying pressure. And that's exactly what actually happened here. It came up, broke structure right here. This is about where it took place, pulled back and immediately got bought up, pulled back, got bought up, pulled back, got bought up, pulled back, got bought up, right? So it was just very high risk to reward ratio opportunities, really good risk to ratio opportunities after this CHoCH appeared. Okay. Again, it's not always the case, but it's pretty common. Let's go find another one because these are fun, right? This is a good exercise. Here's a BOS. Why is this a BOS? Because it's still in a downtrending market, right? So you have BOS, BOS. Um, and then this is where the last CHoCH was. So, and it's a solid line CHoCH. So this means you have a change of character to the downside. So as soon as this happens, you're not looking for buys anymore. You're looking for selling opportunities. This one Came up, pulled back, came up, pulled back, came up, pulled back, came up, pulled back. It actually had a pretty significant move to the upside, but it was ultimately met with selling pressure afterwards. And I think it all started with the CHoCH over here. All of this is what kind of set off this in motion to the downside right here, as you can see. Let's go find, let's continue. This is really fun. I actually like doing this. I hope this helps you guys. So let's go find out. Here's another CHoCH right here. So here's a CHoCH to the upside. Again, it's the first break of structure, major break of structure in a new trend. So that means you were in a downtrending market. Now you have an uptrend, right? So here's your change of character, breaks trend. Okay. You got to be on high alert as soon as this happens, right? So when this happens, market comes up, has a pullback, great opportunity to buy, great opportunity to buy. It pulls up, pulls back a little, comes up, pulls back a little, comes up big time, right? Pretty cool, right? Game changing, actually. So this smart money can be pretty helpful. Let's find, these are all breaks structures to the downside, as you can see. Here's a CHoCH, right? Here's a CHoCH, right? Solid CHoCH line right there. Breaks structure in a new trend, comes up, pulls back pretty hard, right? Same thing over here. It actually comes up. I'm surprised they didn't call this a change of character. I almost would have, but I guess that I'm surprised that they didn't call that a change of character. But anyway, it comes up, um, sells off, as you can see here, sells off, and continues until here, and then it changes directions. So far, so good. Most of these have been pretty significant. Here's a BOS. Here's a BOS. It's a big BOS right there. Wow. Here's your CHoCH right here. Okay. Change of character, break structure right there. And then you're looking for pullback buys. This one actually pulled back pretty far. It pulled back all the way to here, here, and here. And it didn't even make a change of character. It just pulled into some demand that was down in here. It liked this demand, and then it just went off to the races. Anyway, maybe we'll look at like one more. But actually, before I move on to look at one more, I hope you can see they're powerful, but also at the same time, you got to be careful too, because a lot of the other examples I showed you, you had a change of character and they pulled back ever so slightly and then they went back in their directions. This one had a change of character, pulled back pretty significantly actually before it continued off into the up direction again. So you can't just buy because you break structure. You have to, if we were to go back in time, we'd have to find, okay, is there liquidity down in here that we can buy at? Okay, great. If there is, we'll buy. You might have even bought in here. I probably would have, to be honest, and I would have made money for a little bit and then ultimately lost, right? So they're not all going to be 100%, um, because some of these can pull back pretty far before they go in your favor again. These are all breakage structures to the downside, breaks the structure, breaks the structure. Here's your CHoCH, right? This is a good one. This is actually a really good one. So you had a nice change of character and then pulls, breaks character here and structure and has on the last attempt rally at the upside here, grabs some liquidity, and then it's gone. Absolutely gone at that point. But again, if you're not careful, you could lose a lot of money if you sold like right here. You could lose a lot on that unless you had your stop loss just outside of this. But at the same time, you could have made a lot of money on the downside after this CHoCH. So the CHoCH sounds the alarm, basically. Sounds the alarm and says, hey, we're probably going the other way now. But it's not always the case. I want to find one that really fails. So far, all of these have been pretty clutch. Like this one right here, pulls up big time change of character, has a pull back into here and works out pretty well. Um, and then I want to find one that doesn't work. Just because I need to show you guys that it's not 100%, right? Here's a good one. Nice breakage character structure, comes up a little bit, down, comes up a little bit, down, comes up, just pretty much bearish after ever since that change character. Let's find, here's a BOS, 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 all BOSs to the upside. BOSs to, here's a change of character. No, this one worked great. This is exactly what you want to see. Change of character, pulls back into some liquidity, boom, upside. Pulls back into liquidity, boom, upside, right? That's what you want to see after a change of character. Okay, this one might throw you off, actually. Yeah, this is a good example. So, I mean, ultimately it broke structure here, changed character. Came up a little bit, pulled back. That's what you'd expect. Came up a little bit, pulled back some, but it really didn't do very, very well. Like it came up, had some times where it pulled back, but ultimately wound it up breaking to the upside. So this change of character did not last very long. Okay. So I just want to point out that it's not like some magic bullet either. You still have to trade liquidity. So for example, I can guarantee you that this would have been a liquidity zone right there, after this break right here. And the market came right up to that liquidity zone and pulled back. That's a great little trade. That's a great little trade after that change of character. So if you're still trading liquidity in conjunction with a change of character and break of structure, that's the way to do it. I'll trade anything like breaks of structure and CHoCHs, but some people might just trade CHoCHs. Um, um, oh yeah, okay, here's one that really did not work out. This is what I was looking for. It was an example like this. Okay. See this? It's right in our faces right here. This is annoying. See that? That's not what you want to see, but it happened. That's why you still have to manage your risk because nothing's a magic bullet. See what I'm saying? Broke structure right here, had a change of character. You're thinking buy, right? I'm thinking buy. We're all thinking buy. And then what happens? It just sometimes doesn't work out. Sometimes it just doesn't. And it doesn't even come back until much, much later, right? So yeah, I think we just have to be careful with some of these. And so what do? I think you'd look for your demand zones. So potentially you had a buy maybe in like this area, and it maybe had a moment of glory for a second, and then ultimately failed. Hit your stop loss right there, and then you're out. So as long as you're managing your risk, you'd still lose, but you'd manage a manageable amount of money. You'd lose what you were expecting to lose, and that's okay, right? But I wanted to find an example because I showed you a lot of really good examples there, and you can see, yeah, for the most part, it's powerful. But there are times like this. This is a prime example of just it kind of people would call this that the market's rigged. I don't think it's rigged. It's just natural recourse, natural whatever taking place. And so what do you do with that type of situation? Well, you manage risk. That's what you have to do. And you have to be humble enough to get out of bad trades and have a method of getting out of bad trades because sometimes you're just going to get it wrong. You're just going to be wrong. But like I said, most of the time, like if you have an edge like this, you're going to be right. Let's find this is all okay, here you go. Like this is a really good one. Okay, here we go. Last one was not good. This is a really good one. Here's a change character, right? Break a structure, change a character, so more powerful, right? Then you have a um nice little move to the upside, and then it gets smashed back down. Nice little move to the upside, comes right back down. Upside comes right back down. Upside comes right back down, right? Beautiful little thing going on there. It's exactly what you want to see. Okay, so I spent a lot of time on the charts. I think that's all about I wanted to show you guys today. Again, the focal point is just showing you how to use indicators with your price action, okay? Because everything lives and dies by structure and liquidity. That is how trading works, okay? Um, Structure and liquidity, okay? And so anything we use, any indicator you choose to put on your chart needs to help you in that process of trading structure and liquidity, right? Um, right. I mean, you can trade other things, but I mean, there's, oh my gosh, millions of ways to trade, literally millions of ways. But I want to make sure that here, let me go back to where this market is. When you're trading the markets, I want to make sure that it's very clear that um, the king is price action, and within that king of price action, you're looking for structure breaks and you're looking for liquidity zones. And so if you're going to use an indicator, that indicator needs to help you find liquidity and or breaks in structure. And if it doesn't do that, then it's not a worthwhile indicator. And you might as well just trade pure price action and not trade any indicators at all if that's your approach. So all right, guys. Well, I think that pretty well covers it. I'll get this recording posted on the calendar. I hope this was helpful to several of you, or at least somewhat eye-opening to some extent. We got a good lineup this week. Obviously, tomorrow another live trading class. Wednesday live trading. We've got the Sentiment Lab and COT report, so it's going to be a great week. So, anyway, guys, looking forward to it. Have a fantastic rest of your day, and we'll see you guys in the next webinar.